So I guess, yeah, if you can just give a little intro and talk for a little bit. I think you just have so much to offer this group.
Yeah, no problem. Glad to be here today. Thank you so much, Mike, for having me. As Mike had mentioned earlier, I'm Dr. Richard Munassi. I'm a physician. I have an MBA as well, though I haven't seen a patient in about 12 years. Been in the tech sector over the past decade plus, a couple of different companies that I've gotten lucky with, medical diagnostic software, medical education software, as well as a fintech play in healthcare, building software for hospital CFOs. Current company is MedZoomer, as Mike alluded to. We launched it in November of 2020. Kind of in the midst of all the madness with pandemic. What we do on that side is last mile prescription medication delivery. So think Uber Eats for medications, but we actually are a B2B company. So we do not engage with patients with regards to marketing. We are that infrastructure and logistics layer. Outside of that, I do run a tech accelerator in Tampa called the Tampa Bay Wave that's been around for 14 years. I came on board as director about 4 years ago and change. Since then, we've had a significant amount of high growth startups come through the door. The last year or so, we've had about a $250 million worth of liquidity events on the Wave side. We've also had historically, I think we're about $500 million with regards to funds raised with regards to our portfolio companies. And then one of the most, important statistics that I'm proud of is since taking over as director of that program, 85% of our teams that have come through our program are led with founders that are minorities, military veterans, women, or LGBTQ plus founders. So we're big on diversity. We don't look for it. It is very much a blinded part of our application. But given the fact that we are located in Tampa, a very diverse city, we have a very diverse team. The CEO and founder at the Wave is actually a woman and former Columbia MBA and then former at Anderson. It's just one of those situations where we kind of attract everyone and anyone. But that being said, I'm also tied to a couple of different programs, including Founder Institute. In fact, I just had breakfast in Houston with one of the heads of Founder Institute Texas a few days ago. Also part of the team in Mass Challenge and FedTech out of DC, and a couple of other programs, including the University of Florida, where I am the entrepreneur in residence. So my last decade or so has been really focused around technology startups in particular. Happy to be here and help each and every one of you in any way that I can.
And I think, again, we can just open this up to questions. So if you want to either post questions to the chat or unmute, again, there's just a ton of awesome experience here.
The first couple ones are always shy.
I know. I'll ask you some questions if they won't.
I guess I'll start with this is, when I think about a company in particular, any tech startup, how I look at a company and judge its viability, and I'm putting on my investor hat on it. The first thing that I look at, more important than anything else, is actually the timing. Is this the right time for your solution? Is it too early? Is it too late? Are there too many people in the market? With regards to your solution, is it so differentiating enough that it's going to be able to make an impact right now? So I think I'll kick off the conversation really stressing with each and every one of you, as you're looking to build and launch your company, really think about the timing of things and how right now, here in Q4 of 2021, it is the right time for this solution to hit the market. And then why? And make sure that's a big part of your narrative with regards to when you engage with investors, or even people that you're looking to bring on board from a team perspective.
I think that's a great point.
I find a lot of startups don't think about it. They always want to talk about the market opportunity. They want to talk about who they have on their team or who they're connected to or the cool stuff that they're building. But really locking in on that timing portion of things. If you can answer that question, everything else can really be adjusted for. You can bring on new team members. You can build out better solutions with regards to the technology. You can expand your team on that side. The potential for opportunity. You can play with your margins, but the timing of things is something that you can't control, and that's why I think it's so important.
Yeah, it's great if you can show that you're riding a wave. And that the wave is growing, right? So if you're showing the market side, and I think there are two market size numbers, right? There's sort of the top down, this is a giant market, it's growing, everyone in this market is going to make money, right? And then there's a bottom up, but we're not just anyone. Here's our plan, right? Here's who we're going after inside this hot growing market. And this is why now's the time. And this is how we're going to reach those people. I think those kind of pitches light up the room full of investors. All right, we have some questions coming in.
So on that thread, Mike, if I can
Yeah, go for
ask a follow-up on that for you and Dr. Munassi.
Yeah, go for it.
When trying to understand total market size or even the addressable market, is it? I mean, it seems really research driven. How do you bridge that gap between like too much research, or do I have enough to justify that market?
So this is a super common question that I hear all the time from technology companies in the early stages, is around total addressable market. The answer is a lot more simple than you may realize. When you are giving your total addressable market, it's not the market size. It is literally, if you had 100% of the customers you're selling to, how much money are you gonna get per year? That's it. It's a pretty simple question, right? So if I'm selling this to a certain demographic in the United States, this software, let's say I'm selling some sort of energy software to energy companies. I know that there's 1,000 energy companies. Those 1,000 energy companies are going to pay me $1 million a year. 1,000 times $1 million is my total addressable market, and that's it. So really make sure that you're locking in on what TAM truly is. I think there's just a lot of gray area and misspeak when it comes to startups understanding TAM. And I'll even do you a solid. I'm going to drop into the chat probably the best TAM explainer video I've ever seen. It's like a 5-minute video on YouTube from Dream It. And I think you'll like it a lot. I'm sure the whole audience will. I highly recommend watching.
Okay, and then a follow-up on that, because there was something that you slipped in there, which was the $1 million a year. So that's sort of that other piece, which is what will the market bear, or what will the prospective customers pay? So this is another area that, I mean, do you just start with your best guess of it'll be $5 per month or $1 million a year? Because that influences what that total addressable market is.
Well, that's a little bit of a spread, so I prefer to be careful between $5 or $1 million per year. Oh, did somebody say something? Oh, okay. That's okay. What I would say is this: getting a small sample size with regards to your potential customers and surveying. I mean, that stuff is so important. Right? There's a reason why the lean startup methodology is so critical and why it's used by so many startups. Really that sort of explore, probe, test, and then refine, like that feedback loop. It's not just in building software, it's also with regards to your business as well. So the more that you can really show that you validated this price point across volume in particular, the less risky the opportunity is to an investor. And at the end of the day, all of this stuff, anything when thinking about early stage investments, it's also about risk. There's another question I saw pop up in the chat with regards to, it was single founders, right? How do you raise money as a single founder? Well, it's something you gotta be really careful of, because if you as a single founder get hit by a bus, what happens, right? And this is something that like investors will literally say in a closed room. It's only one guy though. If he gets hit by a bus, what do we do? And they'll like use that terminology, because the truth of the matter is like it happens, right? You can't control the world. We've all seen that in 2020. Right? The best plans often go to waste. So it's you as a founder, your responsibility to de-risk things as much as possible, whether that is bringing additional human capital on board from a leadership perspective, having a succession plan in place, or like you're saying, doing your market research with regards to price point. Yeah, but the one thing to remember though too, your TAM will likely change over time as you figure out more potential revenue streams from what you're doing, and as you hear more feedback from your customers. So don't be hard and fast to whatever you find. Understand that it's a moving target, and as you learn and grow, you will find out that things are going to change. So like, if you have a couple of minutes, go down the Google rabbit hole of how does Uber make money? How about that? I think you'll be very, very surprised at what you find.
Uber doesn't make money. They haven't made money the whole history of the company.
They're not profitable, but how they're generating revenue. How about that?
They're the world's largest transportation charity.
Absolutely. Don't forget someone said they cheat their drivers. Don't forget the data sales too.
Right. And I think someone says for market size calculations, which approach would be recommended, top down or bottom up approach? I have an answer, but I want to hear yours.
Just calculate the way that I told you, like just 100% of the market, how much you're gonna make each year. Make it real simple. Don't ever say, if we get this percentage, we're gonna be at this much. Like, don't ever do that. That's a very common mistake as well. Mike, you wanna dive in on that?
Yeah, I totally agree with everything you just said. I think that provides a really good top-down number, and I would also put some growth in there, right? Again, if you can show that that market is growing, not just big, but growing, that helps a lot. I do think one of the places where startups run into some trouble is it's hard to go after a giant market, right? Because the marketing is really inefficient. And so I think we look at as founders, we look at companies like Facebook and Amazon that are all things to all people. And we forget that Amazon started with only books and Facebook started with only Harvard college students, right? And for a while it was only Ivy League college students and then was only college students. And so I think, top down, there's a giant market, but bottom up, there's some place to start, right? That allows you to create a product and get the language right and get the marketing right. So I think some combination of top down giant opportunity and bottom up realistic first goal goes a long way in these investor pitches.
Yeah, Mike said something really interesting there. The show that the market is growing. So there's a specific metric that I just popped into the chat there that you guys should all know about your market.
Yeah.
And that is how much it's growing each year, right? The compound annualized growth rate. Do this, and then on your slide deck, show the TAM right now and show it to me in 5 years, okay? If it's the growth rate's big enough, it's gonna be significant jumps between the two. So real simple, 2 circles, one that says like 5 billion, one that says like 12 billion. Things like that, it really tells a story, and you don't have to sit there and talk to tell that story. That one slide, those 2 visuals tell me everything that I need, especially if in the middle you have the CAGR on an annual basis.
Great. And one other thing I will say about pricing, because I love this question, like what should we charge? One of the best suggestions I've heard actually it was another mentor at Founder Institute. His process was that he would sit down and imagine the highest price that he could for his product or service, take that and then double it, right? So he's got some like crazy high price, and then go and try and negotiate it with 20 different target customers. And he said after doing that, he would then have a range of where his pricing should be. I haven't actually tried that, but it sounded like a pretty amazing process if you had the courage to do it.
That's a really, really sharp way to go after that. And very interesting. I've never heard that before. I really like it. I will tell you this, we have a number of enterprise software solutions that come through our program in Tampa. And I would say my gut instinct is half of them are probably charging 30% less than what they can get, if not more, simply because they got locked into a number and then they just don't know, they don't have the, I won't say they don't have the courage to, but they're just very comfortable with that number versus pushing themselves outside of the comfort zone and going after more money. So here's the thing, like if you, let's say you double the price of your software, but if you're only losing 10% or 15% of your current customers, who cares? The numbers more than make up for it. But it's your job as a founder to understand that elasticity of the price and where it provides the most value to you as an organization. And then to always remember that, the less people paying you more money, the less headache. So try to remember that as well with regards to the customer service side. Because that old adage, 20% of the people cause 80% of the headache, that is totally true, no matter what type of business you're in.
And that's true of fundraising also, right? Like if you can raise from one or a few larger investors versus a bunch of investors, some of whom are going to complain a lot or try to, steer the ship or whatever, that is true too. And Richard, can you talk about your experience bringing on multiple investors into different rounds and how you kind of navigate that?
Yeah, that's a really good question. And you want everything to build on everything else. So, I'm all for bootstrapping. I think that's a wonderful way for you as a founder to retain your equity. But the truth of the matter is, like, we're all here to build high growth startups, not small businesses that run for 5 or 7 years and only hit a couple of $1 million in revenue over that time. We're here to move really, really quickly. And putting fuel in the fire with regards to additional capital is a critical way to drive that. So, I tell people all the time, like, look for investors that are going to be value add. Look for people that are going to push you, that have the network to add to you as well, and then leverage the hell out of it. So when it comes for investment, there's almost like a waterfall situation, right? Your earliest investors that believe in you, many times they will be the ones introducing you to your next round of investors, and then the ones after that. There are relationships that are built up and downstream that do provide significant value and cut the time when it comes to fundraising, especially at the latter stages, your Series A, B round, and onwards and moving forward. As far as understanding what investor is right for you. So there's a question earlier, who's the best investors, angels or VCs? That question tells me that the person asking maybe doesn't know the difference between the two. There are significant differences between institutional investment and angel investment. And that's something that if you don't know what that is, that's okay. Everyone is here to learn, right? No one knows everything right off the bat and born with any of this knowledge. But really getting a good grasp on how investors differ is critically important. So I would highly recommend a book. I'm going to drop into the chat. Venture Deals, written by the founder of Techstars, Brad Feld, and it is probably the Bible when it comes to investment and early stage investments in particular. So that's something that I highly recommend everyone in here. If you haven't read it, as soon as this is done, jump on Amazon, buy yourself a physical copy, and read this book as soon as you can. Use a physical copy to annotate. So treat it like a textbook versus just reading it. This is why I don't actually recommend the audio version of this book, because every page is high yield, incredibly high yield. And if you don't have the ability to mark it up, you are going to miss things, and some of those things that you miss might end up costing you big time in the long run. So that's kind of what I will say with regards to at least the first part of what I remember Mike's question was around early stage investing, but more than happy to shed more light on things. But I think this is another kind of critical component of your knowledge base that I highly recommend everyone should get. Another book is called the second book that I dropped in there, Secrets of Sand Hill Road. The section in there on term sheets might be the best thing I've ever seen with regards to breaking down the term sheet. So those two things together will really fill your knowledge base and give you the ability to, I won't say be on level ground, but at least give you the ability to speak the language and be comfortable with the terms that are thrown around in the investment room.
Also, Brad Feld has an online, Brad Feld is the author of the first book that Richard recommended, Venture Deals. He also has Brad Feld term sheet series online that I'll post here. But this is an amazing breakdown of what's in term sheets for investors. But the short answer to your question about angels versus VCs, angels are individuals, right? And those tend to be earlier in a company's life cycle, right? So those tend to be idea and seed stage. And then VCs come in, Series A, Series B. Some VCs come earlier, some come later. There are no hard and fast rules, but VCs are groups of people, typically. And to Richard's point, when we raised our $2 million Series A from a VC firm in San Francisco for Slide Rocket, we got $2 million, which was incredibly useful, right? But also the VC who joined our board, he had started a software company, he had taken it public, he had then been a VC for 10 years and worked with a ton of startups. And I swear he was as valuable as the $2 million. Like, he made all kinds of introductions to customers, partners, employees, found us a CEO when we needed one, helped us exit. I mean, it was just unbelievable the amount of value that guy was able to bring to our startup.
Yeah, and sometimes the angel does the exact same thing with regards to the value add. Sometimes they don't. Sometimes the VCs do, and sometimes they don't as well. So, really understanding the ability for your investor to provide additional value is critical. Lots of investors will be upfront, like, hey, look, I'm making 90 bets, because if I make 90 bets of small checks, I'm going to 3x my aggregate amount of money I'm deploying. Like, the numbers actually show that, like, that's actual data. Any angel investor that puts essentially 90 different investments out in the world, no matter how much money they're putting out in aggregate, will most likely 3x that opportunity. A quick question from Lydia. Yes, I do believe safes. Yes. In fact, like, we just raised 2.5 million on safes with a 10 cap. With regards to VCs, one other thing that's really important to realize, venture capital firms are investing someone else's money. Angels are investing their own money. So because of that, venture capitalists are held to certain standards by the people that give them money. They're called their LPs. They are bound by a time window to put in a certain amount of money, deploy, grow the company, deploy more money into the company when it's growing, and then sell their investment. The SEC regulates a time mandate. It's like bracketed around 10 years. So understanding where your venture capitalist is in their life cycle will tell you a lot, because then you can know if they're going to be able to give you additional capital, if they're going to want to sell their interest soon, all those sorts of things.
So I have a question. So basically, I'm based in Germany right now, and I'm gonna travel to the US at the end of December and try and raise capital. And basically, I started like making a list of like top VC firms and all the partners and investors, and finding the emails. And I was planning on like sending out some cold emails before I take my flight. But I just want to know, do you have any tips on connecting with VCs or angel investors? Because that's,
Sure.
yeah.
Volume. Yeah, leverage a US-based accelerator. That's probably the fastest way to kind of cut the curve. But on the flip side, volume, right? This is a numbers game, okay? One of the strongest companies to come through our program in Tampa went from a seed round of funding where they raised like 7 million to raising in the tens of millions in a B round of funding, all within 18 months. So they went from a valuation of very little to a whole bunch in about 18 months. And they did that, and it was still incredibly difficult for them to fundraise that first round of funding. And this was your stereotypical white male with an Ivy League background. And it was very interesting to watch him struggle as well. So just be aware that, you see these numbers getting tossed around. People seem to be getting being able to raise funds left and right. But it is a numbers game. You have to treat it like a sales process, have your pipeline, have a CRM focused solely on investors. Mike and I's good friend, Nathan, that runs Founder Suite out of San Francisco area. That is a really, really good investor focused CRM that I like and I recommend to people. I'll drop it in the chat here as well. But, leveraging any warm introductions in particular would probably be of value for you with regards to anyone you have a secure connection with through LinkedIn. And then also don't be afraid to cold outreach and really go out there from the website side for each of your funds as well. Because you'd be surprised, like everyone has associates or principals that are sifting through what's coming through. They'll say, like, oh, we don't look at cold outreach, but that's probably incorrect. Just make sure you're buttoned up and actually ready, and that you're doing it in a professional manner.
Yes, okay, perfect, thanks.
And I also think part of the fundraising journey is figuring out who the right investors are, right? Like, I think at the beginning, we just think of this, like, there are VCs, there are angels, like everyone will invest in my startup. And really, it turns out each VC and each angel has their own preference for the types and the stages of companies they invest in. So most of the time we end up pitching the wrong people first, which is actually a blessing, because that gives us a chance to practice our pitch, get asked the tough questions, hear the pushback, and evolve the pitch. So by the time we do figure out who the right investors are and get in front of them, we're stronger and more likely to capture their attention and their imagination. All right, we have a question. How much do investors like to control or recommend strategic or market directions? I feel it might be harder to pivot after getting investment.
Well, Mike, can you actually copy and paste that into the text? Because
yeah, I can. This is from Cindy.
Really good, really good question here. The best investors don't, right? They're there to help you with your decision making to grow the company. Most investors, we talked about angels earlier, having up to like 90 or I have friends that have put money into like 150 startups. But there's no way they're going to be able to spend time with any of those guys with regards to helping them drive strategic or market directions. They're just there like, hey, text me if you need something. Okay, can I help you? Real quick, let me see your investor update, have an ask in there, and then they'll probably do a connection. With regards to, most likely, you're not even going to talk to your investor unless it's with your update that goes out once a month or in board meetings, if they're even on your board. So pivoting after getting an investment, it's 100% up to you. Now putting on my investor hat on, right? If I'm going to trust you as a founder to do what you're telling me to do, I'm going to support you in any way that I can. If you see something better out there that you can maximize the opportunity or investment, I'm going to help you with that too, because I don't want to run your fucking company. Like, that's not my job. My job is to help you do whatever it is you're trying to do, and then help you give me my money back, hopefully with some more money on top of it, right? So I would worry a little bit less about that. That being said, be mindful. There are predatory investors out there that will look for opportunities to get into a high growth startup and then leverage their influence to kind of shove in their own people and push people around and out of the way. That does happen. Just be mindful of that too. And then the last thing I'll say is this, is it's okay like to be a founder and a CEO and then transition into a secondary role downstream when your company has outgrown you. Mike did that, right? And I know a bunch of people did that.
Oh, great.
Yeah, it's totally fine. I mean, Google's founders, they're not the CEO and they're not running it right now, but I think they're doing pretty good for themselves. So, just remember that you always want what's best for the company first and foremost. And sometimes that means that, hey, the CEO that grew it from the earliest stages, maybe they become the chief strategy officer, or they become the head of product, or they become the chief revenue officer, or the CTO. That happens all the time. Don't take it as an affront. It's going to make you more wealthy. It's going to drive things forward. And just, understand that it's just part of the process, and kudos to you for building something that's so big that you're bringing in world-class people around you to take it to where it needs to be.
Yeah, and I think, my experience when we raised our Series A, we pitched probably 40 different investors. And honestly, the ones who were trying to control us and tell us what to do were A, annoying, B, wrong, C, they were never going to invest, right? And D, if they did invest, I don't know, it would be like a bad marriage where you're married to someone who's just like bugging you all the time and telling you to behave differently. And it's really not what we wanted. And it worked out much better when we found investors who would help us and were supportive. And when we had to pivot, they were supportive of that. And they made all kinds of introductions, but they were very, they were very hands-off about specifically what we were supposed to be doing all day, every day. All right. Lydia recommends.
Let me add something here real quick.
Yeah, go ahead.
Mike, I'm so sorry to pop in. How my companies have historically used investors is this. This is the type of person I'm looking for this particular role. If I'm like hunting human capital, these are the organizations I'm trying to get in front of if I want to cut sales cycle. Okay. These are the other investors I'm trying to get in front of for my next round of funding or to fill up this round of funding. That's another way you use investors. This is a couple of problems that I'm really trying to solve right now. I could use your help and brain power or a couple of people to talk through this. That's another way for you to use investors. So remember that they're a tool for you guys to use as well. Don't expect them to run your company. Be very mindful of their time and be very strategic with your engagement with them. And if they're causing a problem, be firm with them and just let them know, like, hey, look, guys, we're locked in on this. It's working for us, in our opinion. Really appreciate it. We will 100% take your advice into account. And then, be respectful of them. But you are the CEO and you're running your company. And at the end of the day, you're going to get fired, but you can't use the excuse that, oh, well, investor A told me this. Like, the board's going to hold you accountable for your actions and your decisions. So take control of it and take charge of it.
I couldn't agree more. And Richard, I'm going to circle back around. You mentioned you raised $2.5 million off of a safe recently in your last round, and you mentioned a 10 cap. Can you talk that through a little bit? Because that may be a little jargony.
Yeah.
for some of the people on the call, and I think it's an important point when raising money.
Yeah,
Why did
absolutely.
you safe and how did you structure it?
Yeah, that sounds good. So we structured it as a safe, which is like essentially a very simplified agreement where you're not getting, the investor's not getting equity at that particular moment of time of exchange of funds. They're getting equity at the next round of funding when there's a price round. The reason why you can leverage a safer convertible note as an early stage company versus just selling equity, it's much cheaper and faster to do that versus doing a price round. So it essentially allows you to kind of punt that downstream. It also allows you to avoid the conversation of what's the valuation of a company until later when it's set at the next round of funding. But it allows you to bring in the working capital that you need to build and grow and launch your company. The cap is essentially what you're saying that, let's say we raised $1 million on a $10 million cap. That means no matter what the next round of funding is from a valuation perspective, the investors that gave me $1 million today are going to get $1 million against $10 million. They get 10% of the company, even if the company is valued at $20 million, because they gave it to us early. That's kind of like their the carrot for them, or the sweetener for them, is that there's a cap on the valuation at the next round of funding. If it was uncapped, then even though they're taking on a higher burden of risk earlier, they're going to get valued at 25 million, which completely changes their ownership downstream. And this is an hour conversation in and of itself.
Yeah, it's like they would
the different investment vehicles.
They would get punished if you hit a home run using their money, right? So the cap protects the investor from you overachieving, and it also protects your relationship with the investor, because I guarantee you, if you overachieve and they get left out, that is going to be a tough relationship moving forward.
Do you recommend a cap or a discount?
Sometimes it's both, right? I think the cap is the most fair. Discount's fine as well. You know, if you do both, it's going to be whatever's better with regards to the turnover on the investor side. Uncapped is something I would not recommend because it's unfair to your earlier stage investors who are taking the gamble on it. So even though you can probably negotiate that, it's probably not in anyone's best interest, because then they're going to feel cheated with the gamble and so forth, and they're going to get screwed over.
And if you have no idea what we're talking about, I'm posting Y Combinator does a walkthrough of safes that I just posted, but I'll post it again in the chat. So check that out.
Yeah, they actually invented it years ago. Certain geographic regions will push back and try to do a convertible note. But like, in my opinion, it's stupid to do a convertible note because like safes are always faster in my opinion. So if you can get it, try to get that. And if someone argues against it, they're probably not the right investor for you to recognize.
Okay, I'm just going to go through we have a lot of questions actually. So Lydia suggests a book called How Smart Companies Design the Product Around the Price. It talks about finding customers' willingness to pay. I haven't read that book, but I love that concept, because really startups are behavior change machines, right? And it's easy to get distracted by building a product, but really what we're trying to do is change people's behavior and then monetize that behavior. So we want to make sure that we're proving that we can do that early on, which actually makes the conversation with investors easier. There's a great book called The Right It, IT, by Alberto Savoya, who used to work at Google, who talks about, proving behavior change and monetization off a napkin sketch versus building something. So Lydia, thank you for the book recommendation. I will check it out myself. Richard, one for you. Is TAM always calculated annually, or is LTV considered?
So those are two different things, right? Your lifetime value is how much money you can make off someone over a 5-year period. Your total addressable market is how much you're going to make if you have 100% market. So where we see LTV being the value is when you look at it against the customer acquisition for the CAC to LTV ratio, which is typically how much money, if it costs me let's say $100 to get a customer who's paying me $1,000 per year, and I think they're going to be there for 3 years, like what we hear FTV. That means it's 100 against $3,000. That's a pretty darn good CAC to LTV ratio. Sorry guys, I'm moving to a private. There's just like a whole bunch of like.
Yeah. Okay, what about a platform where the users are not the customer? Instagram, Facebook, job boards, Yelp, etc. Great question. These are very expensive businesses to get started, right? Like if you look at the amount of money that Facebook had to raise in order to build their network, like they were essentially professional fundraisers, right? So it's fine. You can start those kinds of companies. It just, I recommend one of two things. One, get very good at fundraising because you're going to have to keep funding. Or two, figure out a way to monetize it, which of course slows down your growth, but allows you to go farther without the constant fundraising. But if you're going to be trying to attract a bunch of free users, I think the most recent example is Clubhouse, right? So remember, Clubhouse blew up last year and they went from, I think in May, they had like 2,000 registered users. And by January, they had 2 million registered users, right? Which is like this amazing growth. In January, the word on the street is that they spent $1.5 million on web services specifically for audio hosting, right? And the way they paid for that was they had raised $10 million back in May when they only had 2,000 registered users, right? So they were exceptional fundraisers. And then they worked very hard and that set them up to be able to pay the bills when they exploded in popularity. So building these free models is not free for you, and it's not for the faint of heart. Richard, do you have any insight on that?
I only heard half of what you said, so
Okay, we can move on. All right, my
No
startup
worries.
100% is relying on economists, analysts, and surveys conducted by top firms such as KPMG, Nielsen, Pew Research. Do I still need to conduct my own survey and justify the market size?
No.
So the answer is no. You can, if you have those top economists, that's great.
Exactly. Well, here's the thing, right? Like, I mean, all this is the best estimation. If McKinsey or BCG or any of the guys you just named can say, hey, this is the market and this is what it's growing, use that as a startup to validate your numbers, please. It's a good thing. And it really can, differentiate you against other founders who are just saying, well, we took estimates based on this and this. If you can say, hey, look, KPMG says this, we're building something for this market, which KPMG says is growing 10% every year, right? That's actually a very good thing.
The one thing surveys can't do is tell you two things. Tell you how your customers will behave, and two, how much they will pay you, right? And that sort of brings us back to what the book Lydia was recommending and the book I was recommending. How do you prove that people actually behave the way you expect them to behave and pay? And surveys don't do that. People lie all the time unintentionally on surveys. Like, sure, I'll buy your service when you release it. And then when you show up with the service, all of a sudden they don't buy, right? So be careful about surveys if you're trying to prove how you think people will behave in the future.
Everyone has a plan until they get punched in the face, right? Very famous quote from Mike Tyson. So everyone can, you can plan and you can have all this stuff, but once the rubber hits the road and you're out there selling, things will change in a very, very quick hurry. So just be ready for that and make sure you're tracking your data to be as efficient as possible with regards to your sales.
Okay, another question that's combining LTV and TAM. In a deck you were sending out to investors, not presenting, do you recommend including LTV and CAC, customer acquisition cost, when presenting bottom-up TAM?
So I'm just going to talk about CAC and LTV. If you have that data and you have enough volume, then absolutely present it. I don't think there's anything wrong with that, and it's good data that many early stage companies just simply don't have and they don't think about. And it's going to come up at some point. With regards to TAM and CAC to LTV ratio, in my opinion, two different slides because they're two different points of data.
Yeah, and I think one of the, so yes, 100%. And I think one of the most important things to investors is the customer acquisition a lot of the time. So the more data you can bring testing around lifetime value, around customer acquisition cost, even if you're making assumptions, if you have some proof, that goes a long way. And then if you have a plan for where the customers are going to come from, right? I think a lot of people show up to investors saying, give us the money and we'll figure it out. That is not a compelling pitch. I think where you've done some research and done some testing and built some landing pages and taken some prepayments, right? Like even Tesla, when they launch a car, they take $100 prepayments, right? Like they do it, you can do it. Okay.
While Mike's looking, I'm going to answer the last question that popped up. Since one has to raise a lot of money, is it logical to hire a professional fundraiser for startups?
Yeah, go for it.
No. Answer is no. You're out there. You have to be the executive team, the founders. You need to be out there raising funds. There's a lot of people out there that say that they can do a lot of different things. Most of them, it's never going to work because people invest in you. They don't invest in someone else. Another thing too is the legalities around this are very unique. In order to sell, essentially to place investment, they have to be a broker. So people that skirt around this, they're breaking the law. So be aware of that as well. And then lastly, you got to do the work. And if you don't understand how to fundraise, and if you don't understand the terms, you're just going to screw yourself over and kill your company. You got to put this work in. As a CEO, fundraising is essentially a full-time job for you guys. So this is part and parcel. There's no shortcuts.
Richard, how much of your time when you're fundraising, so you're running an accelerator, you're co-founder of a high growth startup, you start fundraising, how much of your time are you spending fundraising versus running the business and running the accelerator?
Accelerator minimizes significantly the business. I actually hand off damn near everything to my co-founders and say, look, this is it. It's fundraising time. Like, I'll be around. I'll have stand-ups with them and I'll talk to them throughout the day via text or whatever. But my goal is to cycle through those vendors, the VCs as fast as possible, and to go through and get that money sorted out. And it's a full-time job. It's a lot of touch points, and it's just how it works. That's it.
Well, as a follow-up to that, if I can jump in, Richard, is you mentioned co-founders. So when you have co-founders and it's time to fundraise, is it better to split that up or just have one run the business? Does it make it confusing in a pitch over a Zoom? Or what's your
always, in my opinion, one person pitching, period, number one, that's it. Not multiple people. It's silly to do multiple people. It's in Shark Tank, right? That's number one. Number two, with regards to who should be doing it, I'd love to say it should be the CEO. The truth of the matter is it's whoever's best at it and who can get the deals done. And that's it. Sometimes that's someone else, right? But if it is another person whose job is critical to run the day-to-day operations, I don't have to be that person. Otherwise, you're going to be in trouble.
This next question may be too specific. My company registered in the UK and all my customers are in India. It's an online teaching platform. Will it attract investors in the UK? Potentially, yes. I don't have any particular insight. I would need to know a lot more. And we're both based in the US. So hard to say. I think the one thing I will say, it's easier this year to get international deals done than it has been in the past. But okay. Richard, where is the best place to find accelerators, especially for Black-owned tech startups? I have a Google alert set up, but I always seem to be finding out after the fact.
Talk to Black founders who've been through accelerators. That is far and away your best referral source, because they'll tell you if the accelerator actually is catering to the needs of diverse founders, or if they're just saying it. There's been a lot of say stuff, but not do stuff happening in the last year or so because of what's happened in society. It really bothers me a lot because I see founders being treated like show ponies versus being treated as equal. And I hate that. It really bothers me. I'm a founder of color. I've supported multiple founders of color. My children are multiracial. Everyone in my family is multiracial. So for me, that's a big pet peeve of mine. So really talking to people like Mike or me or other founders who've gone through programs and gauging the temperature with regards to the value, and if this was truly something that was inclusive, probably the best answer for you.
And I just want to give a plug for you. You run accelerator programs, certain programs specifically for women, minorities, diversity. Do you want to talk a little bit?
Yeah, absolutely. So we run a couple of different programs per year, one focused on security, one focused on fintech, one focused on diverse founders, majority ownership on the founding team from women, minorities, LGBTQ+, military veterans, or a blend thereof. And then one program focused solely on female founders from the state of Florida. We are sponsored by corporates who believe in that, who believe in diversity, who put their money where their mouth is, and then provide to us the ability to go out there and support great founders from throughout the country.
Great. And I've
And abroad too. we have founders from all over the world.
Oh, I didn't know you were
including,
doing that.
Oh yeah.
Great.
Yeah, Tech Diversity, that's our program in the summer. We routinely get applications from like 25 plus countries for that. And we've seen people from South America, Europe, Asia, I mean, Africa, literally everywhere apply to and matriculate through the programs that we run.
And I just want to give another plug for you. I work with a lot of the companies that come through your accelerators, and you do an amazing job of setting them up for success. I'm just constantly impressed by the quality of the founders and the companies that come through your programs. So we'll post, and actually we're gonna have to wrap up in a few minutes, but I will post Richard's LinkedIn to the chat. Definitely connect with him and talk with him. We're gonna run out of time before we can answer all these questions. My company
good problem to have.
That's a good problem to have. We're gonna have you back. My company is now in operations and we went viral this year, but since our sales are decreasing a little bit, would it be okay to ask for investment for the first time if the sales are decreasing?
This is a really interesting question. There is no right answer right now. It depends on what you learn with regards to when it went viral. If you tracked your data, if you figured out which areas provided the best customer acquisition, and if you can weave a story around that. Like, hey, look, the virality went down, but in that, we actually pulled all this data, and we know that by raising $1 million or $2 million and going after these two channels, we're actually going to get this amount back with revenue. So if you can really kind of lay out the data and show the value of the fundraise, I think that investors will be more likely to potentially put money into you. But the truth of the matter is, best time to raise money is the minute you have movement and that you can show that trajectory, because you have to move, because you never know where the market's.
Yeah, I couldn't agree with that more. I think you want to strike while the iron's hot. Best time to raise money is when you don't need money. But that being said, you are where you are. And I think, you just got to get out there and get in front of investors and just have those conversations. Okay, we kind of covered this. Under which circumstances would you recommend convertible debt versus equity funding?
Earlier, just lock in on convertible notes and stay, in my opinion, preferably safes. I wouldn't do a price round until like your seed round of funding. It's expensive to do a price round. There's a lot of stuff that goes around it. Another thing that I will also say is this: just be super mindful if you're racking up notes when it does convert, how much you're going to be left with. A lot of founders will raise too much via safes because it's quick and easy, and then they won't do the math or track the math, and then all of a sudden everything flips over and converts, and they hold much less of the company than they realized.
Yeah, I could not agree more. Find yourself a cap table template and really think ahead, because it is complicated. The cap table is more complicated than the financial projections. Oh, and there was a question about financial projections that I skipped, which I should. How much financial planning do you recommend presenting? Sometimes I feel that my financial planning is very positive and can seem unreal.
It's almost always unreal, right? This happens all the time. People say, okay, in the next 2 years, I'm going to have like 50 million in revenue. The truth of the matter is, like, it's going to be a slow burn for the most part. Startups typically have this buildup and growth trajectory where you're learning along the way. Investors know that. Don't think you're going to go out and roll 5, 7, 12% of the market your first year or two. It's just not going to happen. And that's okay. Investors are in it because they believe in you as a founder to figure it out along the way, and to deal with the ups and downs and get where you need to be. So, just be mindful of that. Have projections that I won't say are conservative, but don't let them be runaway projections as well. Find a happy medium that's realistic, and then tell the story of why it's realistic with regards to your data.
Great. All right. And so last question regarding co-founders, I'll be hiring a software engineer developer. I have the vision, the model, etc.
I'll answer this, Mike. I'll answer this real quick. Bringing a co-founder on is basically marrying that person, right? Except they have the ability to take like half your company, or whatever percentage, or kill your company immediately, right? If there's dead weight on the cap table, or if there's a bad choice, or any of the things, be very mindful of who you're bringing on board from a quote unquote co-founder side, because that's what people are investing in, right? Really get to know someone. Just like, you shouldn't run off and get married to someone you don't know. treat the co-founder relationship just like that as well. Be really careful. If anyone has a whirlwind marriage and romance, no offense, I'm sorry. Sure, it's working out great. But I'm just saying that please just be super mindful with regards to who you're jumping into business with. Y Combinator does do co-founder matching right now. I've heard good things about it. I don't know enough about it, but just really understand that you can't rush it. It's hard to do the things that we're trying to do. Okay, it's hard enough in America to make $250,000 per year, rather than build a multi-million or billion-dollar company. So just think about that. It is really important that you're trying to build something, change the world, make an impact people's lives, make yourselves generational wealth along the way. That doesn't come easy, so there's no shortcuts in anything. But that being said, there are definitely templates on how to be successful. And I think hopefully, at least in this last hour we've had together, we provided some value to help you along your journey.
And I will say also that vesting schedules are your friends. Like, don't hand someone equity, hand them a vesting schedule where they earn the equity over time. And usually they don't get any equity for the first 6 months or 12 months. That gives you a chance to work together. And if it's not working, you can exit and you will have paid them maybe some money, but they won't walk with part of your company. So, and actually in the deal terms that we posted from Brad Feld, he talks about vesting schedules, so check it out. Okay, thank you everyone. I'm pasting Richard's LinkedIn again, and he does run accelerator programs, so check it out at tampabaywave.org. He just posted the link. I just pasted my LinkedIn, so check in, connect with me if you haven't already. If you need financial projections templates, check out rocketproforma.com. Everything is on sale this month because it's the month when everything's on sale. And hopefully we'll have Richard back because this was an amazing conversation. And Richard, you get credit for holding the audience the entire time. I think we have everyone stayed around for the full hour, so thank you.
Glad to be of value here to all of you, and please do feel free to reach out anytime via LinkedIn. Best way to communicate with me. Another thing that I will say is this: any cybersecurity companies that either any of you run or any of you know founders in, please send my way and send them my way in a hurry. We have a cybersecurity program popping up Q1. We have some wonderful corporates that are tied to that, including Bank of America, Raymond James, Jabil, US SOCOM, Department of Defense. The list goes on and on. We've really brought together a lot of very, very, very high-level decision makers in cybersecurity, but we're looking for great companies to bring to that program as well. And that's my ask of each and every one of you. Just make an intro, shoot them my way, or send them the website and ask them to apply, because we'd love to have them on board and help them along their journey. And we don't take any equity, by the way. Our program in Tampa is fully funded by the state and federal government and large corporates. Zero equity accelerator program. So the companies that come through are happy because they get to hold on to all their company.
Awesome. Thank you so much.
Worldwide. Any cybersecurity company from throughout the world.
TampaBayWave.org. Also check out RocketProForma.com if you're looking to get your financial projections created quickly. I apologize, I have to shut down the room because we have another call starting, but Richard, thank you so much. You brought so much great experience. I appreciate it. Thank you. And we'll send out a recording of the call with some links after this as well. Thanks, everyone.